All right, guys, let's start. So we are now doing your lesson number two. Lesson number two is about your market risk and your other financial risk, right? So we are still doing your what you say foundation of the market risk. We are doing market risk modeling, and in your market risk modeling, we are looking at your first chapter. That is your foundation of the market risk. And in first chapter, we are looking at your market risk versus other financial risk. Okay. So let's start, guys. Let's try to dig deeper. Okay. Basically, this lesson sets the boundary link or boundary lines, right, between your market risk and other risk types or bank measures. Everything later in the course, which you'll see. Your sensitivities, your VAR, your expected shortfall, your stress testing is built on top of these boundaries because the risk must be classified before it can be measured. Fine. All right. Now going deeper. So first we talk about your market risk versus other financial risks. Financial institutions face several distinct sources of potential loss. Market risk is loss from adverse movements in market prices or rates. Credit risk is loss from a counterparty or borrower failing to meet your obligation. Operational risk is loss arising from failed process, people, system, or external events. Liquidity risk is loss or funding difficulty caused by inability to transact or meet obligations sufficiently. Different risk leads to different loss mechanisms. Key insight is correctly identifying the source of potential loss in the first step in effective risk management. Okay. So basically the slide lists 4 sources of loss and gives one definition is market risk is loss from adverse moves in market price or rates. A market price or rate is number quoted in the market, a share price, an interest rate, an exchange rate, a commodity price. Credit risk is loss when a counterparty or borrower fails to meet an obligation. Okay. The counterparty is the other side of a contract and obligation is a promised payment. Operational risk is loss from failed processes, people, system, or external events. Liquidity risk is loss of funding liquidity from being unable to transact or settle efficiently. If you look at the box statements on the slide, different risks lead to different loss mechanisms. A loss mechanism is basically the chain of events that turns an exposure into an actual loss. The 4 risks differ by mechanisms, not the size of losses. 2 losses of equal size can belong to different categories. Where it is used, the 4 categories map to 4 different measurement toolkits. Market risk gets sensitivity and VAR. Credit risk gets default model. The classification decides which toolkit applies. Then we get into next slide, slide number 3, which is for risk types, the one-line test. One-line test for risk classification, a simple question can help identify the primary source of risk. Market risk, did the market variable move against me? Credit risk, the counterparty fail or weaken. Operational risk, did a process, person, system, or external event fail? Liquidity risk, can I trade or fund the position without unacceptable cost? Market basically is about price movement. Credit is about counterparty failure. Operation is about process system failure. Liquidity is about trading and a funding constraint. Key insight is classify the risk by identifying the mechanism that can generate the loss. So the slide basically gives a clean test to place a loss into one category. Market risk test, whether the market variable move against the position. Credit risk test, whether the counterparty failed or weakened. Operation risk test, whether the process, person, system, or external event kind of failed. Liquidity risk test, whether the position can be traded or funded at an acceptable cost. The position is a holding that gains or losses value. The market variable is any market quoted number that feeds the valuation. The table on the slide is 2 columns. Left column is the risk name, right column is the mechanism. It shows a one-to-one mapping, market to price movement, trade to counterparty failure, operational to process or system failure, liquidity to trading or funding constraint. The test works on the driver, not the instrument. The same instrument appears under several rows depending on what moved. Then we go to slide number 4, the difficult distinction, market versus credit risk. Market risk and credit risk can interact. A distinction becomes difficult when the market instrument is affected by both market prices and the creditworthiness of its issuer. A bond price can fall because market interest rate increases. The same bond can fall because the issuer becomes less creditworthy. The first mechanism is primarily market risk. The second mechanism is primarily credit risk. Delta V is delta V of market, delta V of credit. Risk inside a same position can contain both market and credit risk. The loss mechanism determines the classification. So the slide covers the case where one instrument carry both risks. A bond price can fall because market interest rates rise. The same bond price can fall because the issuer becomes less creditworthy. The first is treated as market risk. The second is treated as credit risk. Creditworthiness is the market's assessment of the issuer's ability to pay. An issuer is the borrower that sold the bond. Delta V is delta V of market factors, delta V of credit factors. The symbol V is the value of the position in the currency units. Symbol delta means change in. So delta V is the change in the position's value per period. The formula split the change into a part driven by market variables and a part driven by the issuer's credit quality. The split is what allows two desks, market risk and credit risk, to own different pieces of the same loss. Clarification here, the additive split is a presentation device, not an identity. Value the joint function of rates and credit quality. The true decomposition carries cross terms and depends on the order in which factors are shocked. In practice, the split is defined by chosen attribution convention and the residual is reported separately. Where it is used, this is the profit and loss attribution problem. This decompose daily profit and loss into risk factor bucket to check to the risk model explains actual moves. Then we get into next part, which is slide number 5, corporate bond example, spread widening. Corporate bond, spread widening, consider a corporate bond whose required yield increases because its credit spread widens. The bond's market yield increases, its market price decreases. The position therefore experiences an MTM loss. The loss is associated with a change in the market observable risk factor. Credit spread increases, leads to bond yield increases, leads to bond price going down. Delta V less than 0 leads to MTM loss. Key insight is credit spread movements are a market risk factor when measuring changes in the market value of a traded bond. So the slide basically traces one event. The corporate bonds credit spread widen, its required yield rises, its market price falls. The position takes a mark-to-market loss. The credit spread is the extra yield the market amount on a corporate bond over a comparable government bond. Widening means that the gap gets larger. The yield is the discount rate that equates the bond price to its future cash flows. Mark-to-market means valuing a position at the current market price rather than at cost. Credit spread increases, bond yield increases, bond price goes down. The chain says a rising spread pushes up the total discount rate applied to a bond's cash flow. The higher discount rate gives a lower present value, so the price falls. Delta V is less than 0, MTM loss. Negative change in position value is recorded as a loss of the date happens with no default required. The slide's point is that spread moves are observable market data, so a spread-driven price fall is measured as market risk, even though its cause is trade related. I want to add a technical clarification here. The first arrow assumes the risk-free rate is unchanged. Yield equals the risk-free rate plus the spread. So a widening spread can coincide with falling government yields and leave the total yield flat or lower. Where it is used, this is why credit spread risk sets inside trading book market risk measurement and spread treated as a risk factor alongside rates and equity prices. Then we go to slide number 6, which is corporate bond example, actual default. Now suppose the corporate issuer actually defaults on its obligation, the issuer fails to make the required payment, the investor faces the potential loss of principal interest. The primary loss mechanism is failure of the counterparty to perform. This is therefore fundamentally a credit risk event. Default is to failure to pay to potential loss. Credit risk is counterparty failure risk. Risk inside a decline in the bond's market price and actual default are related but represent different loss mechanisms. The slide changed the event. The issuer defaults and fails to make a required payment. Investor faces loss of principal interest. The loss mechanism is failure of the counterparty to perform. Slide classifies this as a credit risk event. Default is failure to meet a contractual payment or covenant. Principal is the face amount repaid at maturity. Interest is the coupon paid along the way. Default implies failure to pay, which implies potential loss. Credit risk is counterparty equals credit risk equals counterparty failure risk. The second line is the definition, not an equation with number. It fixes credit risk to one mechanism, the other does not perform. Spread widening versus default, the pair that gets confused. Spread widening, prices falls, contracts still performing, loss is unrealized MTM measured with market risk tools. The one difference in matter, cash flow still arrive. Default, contracts stop performing, loss is realized, net of recovery measured with PD, LGD, EAD. The one difference in matter, cash flow stop. Technical clarification, the two are not fully separate in capital terms. Trading book holds spread risk under market risk and a separate default risk charge because the spread model built from small daily moves does not capture the jump straight to default. That we need to understand. Then we go to slide number 7. Two loss mechanisms can affect the same position. One position can carry multiple risk types. A corporate bond can simultaneously be exposed to market risk and credit risk. Market rates can move against the position. Credit spreads can widen. The issuer's financial condition can deteriorate. The issuer may ultimately default. Bond risk is equal to market risk plus credit risk. For example, rates goes up, price goes down, while issuer credit quality goes down. That implies spread goes up. That implies price goes down. Key insight: risk classification depends on the driver of the loss, not simply on the instrument being held. So basically, the slide is listing 4 things that can hurt a corporate bond holder. Market rates move against the position, credit spread widen, the issuer financial condition deteriorates. The issuer default, bond risk equal to market risk plus credit risk. It has a you know rates up implies price down. Issuer credit quality down implies spread up, which implies price down. Two different drivers reach the same outcome. Price falls in both lines. The driver decides the label. Clarification here is the additional sign is a label, not arithmetic. Risks do not add because the drivers are correlated, and the list is kind of incomplete. The corporate bond also carries your liquidity risk, and if issued in other currency, that is FX risk as well. Then we go to slide number 8. Market risk is a family of risk. Contains multiple market factors. Market risk is not a single risk factor. It is a broad family of risk arising from movements in market variables, equity risk, price movement, interest rate risk, change in interest rate, FX risk, currency movement, commodity risk, commodity price movement, spread risk, change in credit or market spread. Market risk is a function of equity rates, FX, commodity spreads. Key insight: different market factors require different measures of sensitivity in this. So very simple. We understand that the slide is basically splitting your market risk into 5 subtypes, each tied to one class of market variable. Equity risk, we understand moving share price and equity indices. Interest rate risk moves in interest rate and yield curves. FX risk, move in exchange rate. FX is foreign exchange. Commodity risk moves in commodity prices such as oil, metals, and agricultural goods. Spread risk moves in credit or market spread. Market risk is the function of equity rates, FX, and your commodity and spread. The symbol F denotes the function and output determined by the listed inputs. The line says total risk depends on all 5 factor classes at once, not on any one alone. It is written this way because each factor needs its own sensitivity measure and its own set of historical data. I'll add one clarification. The list omits volatility. Implied volatility is a traded market variable and is a separate market risk factor for any book holding option. Standard trading book taxonomies carry 6 classes with volatility risk alongside 5 shown here. Where it is used, this list is a factor map or a war engine. Each factor class needs a price history, a sensitivity, and a shock definition before portfolio level risk can be aggregated. Then we go into credit risk, core definition, and drivers. Credit risk is the risk of loss arising from a counterparty failure to meet its contractual obligation. Probability of default, loss given default, exposure default, change in counterparty creditworthiness, and simplified expected loss relationship is given by this formula. PD is equal to probability of default, LGD loss given default, EAD exposure default. Expected loss is equal to PD into LGD into EAD. Risk inside credit loss focus on whether the counterparty can meet its obligation, how much may be lost if it cannot. So credit risk has been defined here. Formula has been given here, which is very simple. EL is expected loss in currency units. For a stated horizon, PD is the change, or PD is the chance the counterparty defaults in that horizon. A number between 0 and 1. LGD is the fraction of the exposure not recovered after default, also between 0 and 1. EAD is the amount owed at the moment of default in currency units. The product gives the average loss across all outcomes, chance of the bad event, times how bad it is, and times how much is at stake. I'll add one clarification here. The product form holds when 3 inputs are created as independent. They are not in downturn. When default rate rise and recovery values fall together, the correlation is handled by using downturn LGD, loss given default estimates, and by measuring unexpected losses from the full loss distribution. Where it is used, expected loss is priced into the credit spread charge to the borrower and taken as a provision. Capital is held against the loss beyond expected loss, not against the loss itself. So that is what we need to keep in mind very, very clearly, right? So keep that in mind, right? And drivers are listed here that we need to understand. Then we go to slide number 10, which is operational risk. Your core definition drivers. Operational risk arise from inadequate or failed internal process, people, systems, or external events. Human error, system failure, process weakness, internal fraud. External events, operational risk is due to people, process, system, external events. Examples include incorrect trade booking, model implementation failure, technology outage, processing error. Risk insight, operational risk originates from how an institution operates rather than from market price movement, right? Operational risk arises from inadequate or failed internal processes, people, systems, or external events. The slide lists drivers. All these operational risk is the people per process plus system plus external event. Operation risk equals people plus processes plus system plus external event. This is a definition written as sum of four categories. It names the four places an operational failure can originate. The example on the side are incorrect trade booking, model implementation failure, technology outage, and processing error. Each is lost by how the firm runs with no market move required. And clarification here is the standard supervisory definition include legal risk and exclude strategic and operational risk. Model risk is split, a coding or implementation failure is operational, while a wrong modeling choice is usually governed under model risk separately. So then we go to slide number 11, which is liquidity risk. Liquidity risk is the risk that the position cannot be traded, funded, or settled without significant loss or delay, low market depth, wide bid-ask spread, limited trading activity, funding constraints, market stress. It is difficulty in trading or funding. A position may have a quoted value, but still be difficult to liquidate at that value during stress condition. Risk inside is liquidity risk concerns the ability to transact or obtain funding at an acceptable cost, not simply the quoted market price. So liquidity risk is the risk that a position cannot be traded, cannot be funded or settled without significant cost or delay. Driver listed, low market depth, wide bid-ask spread, limited trading activity, funding constraint, market stress. Market depth is the size that can trade it before the price move. The bid-ask spread is the gap between the best buy price and the best sell price. Settlement is the exchange of cash and securities that completes the day. Liquidity risk is difficulty in trading or funding. Liquidity risk equals difficulty in trading or funding that we have understood. The slide adds one line worth holding on to. That is, the position may have a quoted value, still be hard to sell at that value into stress. Quoted price is achievable price separate when depth disappears. Where it is used, this gap is by risk system apply liquidity horizon and liquidity cost add-on rather than assuming any position can be exited instantly at the last quoted mark. Then we go to slide number 12, which is funding liquidity risk versus market liquidity risk. Liquidity risk has two important dimensions: funding liquidity risk, which is inability to obtain sufficient cash or funding when required. Market liquidity risk, inability to buy or sell an asset quickly at a reasonable price. Funding liquidity implies cash funding constraint. Market liquidity trading or the exit constraint. Funding stress can force asset sales. Funding stress market can generate large losses. Key insight is funding liquidity concerns access to cash. Market liquidity concerns the ability to transact in an asset. So the slide basically splits liquidity risk into two dimensions. Funding liquidity risk, inability to obtain enough cash at funding when required. Market liquidity risk, inability to buy or sell an asset quickly at a reasonable price. The slide then links them. Funding stress forces asset sale and asset sales into stress market generate large losses. One dimension feeds the other. Funding liquidity about the firm's access to cash measured by cash flow gaps, your LCR, NSFR, net stable funding ratio, liquidity coverage ratio. Fails when lenders are depositor withdraw. The one difference that matters is the constraint sits on the balance sheet. Market liquidity about the assets credibility measured by bid-ask spread, depth, days to liquidate. Fails when buyers step away. The one difference that matters is the constraint sits in the market. Where it is used, the force sale channel is the standard link between a funding shock and a market risk loss. And is the region stress scenarios model put together, right? Then we get into next one, slide number 13, which is systematic risk versus idiosyncratic risk. Systematic risk and idiosyncratic risk, when we compare, risk can also be classified according to whether its effects are market-wide or specific to an individual institutional asset. Systematic risk can affect many institutions or markets simultaneously. Idiosyncratic risk specific to a particular firm, security, or institution. Systematic, broad market impact. Idiosyncratic, specific entity impact. Example, financial crisis. Systemic. Company-specific fraud. Idiosyncratic risk inside. Diversification can reduce idiosyncratic risk, but it cannot fully eliminate your systemic risk. Again, the slide adds a second axis of the classification, whether the effect is market-wide or specific to one entity. Systemic risk means the risk that hits many institutional markets at the same time. Idiosyncratic risk specific to one firm, security, or institution. Systemic risk basically is a broad market impact. Systemic leads to broad market impact, as I told, right? Idiosyncratic specific entity impact. The financial crisis is a systemic. Company-specific fraud is idiosyncratic. The stated consequence that reduces is that basically diversification reduces idiosyncratic risk, but cannot remove systemic risk. Holding many independent names average away name-specific shock. A common shock hits every name at once, so averaging does not help. Clarification here is two similar words are being used as one. Systematic risk is the undiversified common factor in portfolio theory, the risk that survives Diversification. Systemic risk is the risk of breakdown of the financial system itself through contagion or interconnection. The diversification statement on the slide is the systematic risk result. The financial crisis example is systemic risk. Where it is used, the systemic versus idiosyncratic split is the base of factor model portfolio construction. Diversification limits and concentration limits must exist because only the idiosyncratic part responds to spreading exposure. Then we go to next part, which is business risk versus market risk. Business risk and market risk. Business risk arises from uncertainty in a firm's underlying business operations and economic performance. Changes in customer demand, competition, input cost, strategic decision, changes in operating profitability. Market risk, in contrast, arises from movements in observable market variables. Business risk leads to operating performance. Market risk implies market variable. Key insight is firm share price may reflect both business fundamentals and market-wide movements. The underlying risk driver should be distinguished. So again, the idea here is business risk arises from uncertainty in a firm's own operation and economic performance. The slide lists 5 drivers: changes in customer demand, competition, input costs, strategic decision, and changes in operating profitability. Market risk is then contrasted as risk from moves in observable market variables. Operating profitability is profit generated by the firm's core trading activity before financing effects. An observable market variable is number quoted by the market and available as a price series. Business risk leads to operating performance. Market risk leads to market variables. The 2 lines say the drivers sit in different places. Business risk sits inside the firm's income statement. Market risk sits inside the quoted prices. The slide's closing point is that a share price reflects both. Part of a move comes from the company's own result, part comes from the whole market moving. Business risk driver is the firm's operations. Data comes from financial statements, so reported quarterly. The one difference that matters is not directly observable as a price. Market risk basically driver is the quoted price or rate. Data comes from market price series, past, observed daily or intraday. The one difference that matters directly observable as the price. And where it is used, the split is what makes market risk measurable with historical price data. Business risk has no daily price series, so it is handled through scenario analysis and capital planning rather than war. Okay. Then we go to slide number 15, reputation risk as a second order consequence. Reputational risk can amplify other risk. Reputational risk often arises as a consequence of another adverse event rather than an isolated initial risk. Operation failure can damage reputation. Credit problems can reduce customer confidence. Market losses can trigger negative publicity. Reputation damage can lead to customer withdrawals or higher funding costs. Initial risk event, reputation damage, secondary financial impact. Reputation, confidence, business, funding effects. Risk inside, reputation risk can act as a second order channel through which an initial risk event produces additional losses. This is a slide places reputation risk after another event rather than beside the other category. It lists 4 links: and operational failure, damage reputation, credit problems, reduce customer confidence, market losses, trigger negative publicity. And reputational damage leads to customer withdrawal or higher funding costs. Second order means the loss is caused by the reaction to a first loss, not by the first loss itself. Initial risk event, reputational damage. Initial risk event leads to reputation damage, which leads to secondary financial impact. Reputation leads to confidence, which leads to business and funding effects. Both chains describe the same route. Something goes wrong, counterparties, clients, and then you lose confidence. They withdraw funds or change or charge more, basically. The second loss can exceed the first. One clarification I'll add here is that the final step ties the reputational risk back to your funding liquidity risk from slide 12. Higher funding costs and deposit withdrawals are the mechanism through which reputational damage becomes a measurable balance sheet loss, which is why it is stress tested rather than capitalized on its own. Slide number 16, why risk taxonomy matters for capital allocation. Risk taxonomy guides capital allocation. A clear risk taxonomy helps institutions determine where capital and risk management resources should be allocated. Different risks require different measurement techniques. Different risks may require different limits and control. Regulatory capital treatments can differ across risk categories. Risk concentration becomes easier to quantify or identify. Risk classification leads to measurement, to limits, to capital allocation. For example, market risk, when you try to find out war, short sensitivity, credit risk, PD, LGD, EAD, operation risk, event, and loss analysis. Key insight, 4 risk classification lead to appropriate measurement, limits, and capital allocation. The slide basically gives you 4 reasons classification matter. Different risks need different measurement techniques, different limits and control, different regulatory capital treatment, and clear identification of concentration. The taxonomy is a fixed set of categories with rules for placing items into that. A limit is a cap on how much of risk a risk may hold. Regulatory capital is the equity a supervisor require against a given exposure. The concentration is large exposure to one name, sector, or factor. This classification leads to measurement, which leads to limit, which leads to capital allocation. The chain runs one way. Category decides the metric supports the limit and the metric together drive how much capital is held. The wrong level at step one carries through every step after it. The example given are the metric sets per category. Market risk uses VAR, expected shortfall, sensitivity. VAR is value at risk, expected shortfall is ES, expected shortfall. Sensitivity is the change in position value per unit change in risk factor. Credit risk uses PD, LGD, EAD defined in slide number 9 also. Operation risk uses event and loss analysis. Where it is used, slide is the reason the whole lesson exists. The classification is the input to the measurement course that follows. Then we go to slide number 17, overlapping risk. When one loss has multiple labels, one loss can reflect multiple risk drivers. A single event can transmit losses through several risk channels. Market shock can reduce asset values. A falling asset value can weaken counterparties. Funding pressure can cause asset sale. Operational failures can amplify market or liquidity losses. Market shock leads to credit stress, leads to funding pressure, leads to force sale. The initial event and subsequent consequence may belong to different risk categories. Risk manager must identify both the source and transmission channel. Risk inside risk categories are analytical tools. Real world loss can propagate across several risk types. Okay, so basically the slide describes one event traveling through several risk channels. A market shock cuts asset value, falling asset values weaken counterparties, funding pressure forces asset sale, operation failures can amplify market or liquidity losses. A transmission channel is a route by which a shock in one place produces a loss somewhere else. Market shock leads to credit stress, leads to funding, which leads to force sale. Each arrow crosses a category boundary. The first box is market risk, the second is credit risk, the third and fourth are liquidity risk, one event, 4 labels. The slide stated consequence is a risk manager must identify both the source and transmission channels. Categories are analytical tool imposed on losses. Real losses do not respect them. Where it is used, the force sale at the end of the chain feeds back into the market shock at the start. That feedback loop is what stress testing is designed to capture and what standalone VAR misses. Then we have slide number 18, which is worked example, FX loan to a foreign client, which is given. Suppose the bank provides $10 million loan to a foreign corporate client. Two distinct risk arises, credit risk. The client may fail to repay the loan. FX market risk, change in the exchange rate affect the domestic currency value of the exposure. If $10 million is equal to 830 million, right? Why? Because exchange rate move adversely, which is given, then the domestic currency value becomes 10 into 88 million, right? So FX effect is 30 million minus 30 million. Change side, the same currency, foreign currency loan can create both the credit exposure to the borrower and market exposure to the exchange rate, right? So the idea here is the bank lends $10 million to a foreign corporate client. Two risks arise. Credit risk, the client may not repay. FX market risk, the exchange rate changes the domestic currency value of the exposure. Domestic currency, the bank's reporting currency. Exchange rate quoted at 83 per dollar means 83 units of domestic currency per $1. $10 million is equal to 830 million. This is the starting point converted to a rate at a rate of 83 per dollar. 10 times 83 is about 830. 83 per dollar moves to 80 per dollar. The domestic currency is strengthened. Fewer units are now needed to buy $1. So the dollar amount is unchanged. The domestic currency value of that same dollar amount has fallen. FX effect is 800 minus 850 minus 30 million. So FX effects creates that negative value. The loss is 30 million. Domestic currency units, no payment, one miss. The borrower is fine. The loss is purely market risk sitting on top of credit exposure that is unchanged in dollar terms. Clarification here is the slide calls this an adverse move, which is correct only for a bank whose reporting currency is the domestic one and which has not hedged. The move is favorable to the borrower who now needs fewer domestic units to service the dollar debt. Note also that the currency symbol has dropped out of the PDF rendering. So we have the pair numbers here, 830, 80, and 800 domestic currency amount. Where it is used, this is the base case for FX hedging. The bank removes the 30 million exposure with an FX forward, leaving the credit exposure behind. The two risks are hedged by different instruments because they have different drivers. Then we have slide number 19, which is worked example of a structured note with embedded optionality. And consider a structured note whose payoff contains an embedded option. The note's value depends on the underlying asset price. It may also depend on volatility, interest rate, and time to maturity. The embedded option therefore creates multiple market sensitivities as simplified representation given by this equation. Hence, we have the real equation also. We have where we have delta S is underlying price risk, Delta sigma is volatility risk. Delta R is interest rate risk. Risk inside is single structure product can contain several market risk factors because it value depends on multiple underlying variables, right? A structured node contains an embedded option. You all understand that. Its value depends on the underlying asset price and also on volatility, interest rates, and time to maturity. The embedded option creates several market sensitivity at once. The structured node is a debt instrument whose payoff is linked to a derivative. An embedded option is an option written into the terms of the instrument rather than stated separately. Volatility is the size of the underlying price fluctuation. Time to maturity is the remaining life of the contract. V is the note's value. S is the underlying asset price. Sigma is the Greek letter sigma. R is the interest rate. T is the time to maturity. The line says value is a function of four inputs. Change any one and the value changes. Delta V is approximately equal to the partial derivative of V with respect to S. And delta S plus the partial derivative of V with respect to sigma times delta sigma plus the partial derivative of V with respect to R times delta R. The symbol partial denotes basically partial derivative, the rate of change of V with respect to one input while the others are fixed. Each partial derivative is a sensitivity. Multiplying a sensitivity with a movement factor gives the value change from that factor. Summing the three gives the total value change. The approximation sign appears because only first order terms are kept. The slide names the three factor moves. Delta S is underlying price risk, delta sigma is volatility risk, delta R is interest rate risk. The expansion is first order only, so it is correct or it's accurate for small moves. Two omissions matter here. Second order curvature in S is not captured, which is why the approximation degrades for large underlying moves. Time term is also absent, even though T appears in the value function, so the decaying value from the passage of time is not represented. Where it is used, these partial derivatives are the Greeks. The S term is delta, the sigma term is vega, the R term is rho. Sensitivity-based war and sensitivity-based capital charges are built directly on this expansion, and each term is set with a different exponent. Then we go to slide number 20, risk classification under regulatory framework. Regulatory framework classifies risk to establish consistent requirements for measurement, capital governance and reporting, market risk, losses from movement in market risk factor, credit risk, counterparty or borrower default and credit deterioration. Operation risk, losses from failed processes, people, system, or extreme events. Liquidity risk, inability to meet obligation or transact efficiently. Risk type leads to risk measure, risk limit, capital control. Classification support, consistent risk reporting. It also help prevent the same exposure from being overlooked or incorrectly measured. Final insight, regulatory risk taxonomy provides a structured framework for identifying, measuring, controlling, and allocating resources to different sources of financial risk. Okay. So when we look at this, right, slide restate the four category in regulatory term. Regulators classify risk to set consistent requirement for measurement, capital governance, and reporting. Market risk, losses from moves in market risk factor, credit risk, counterparty or borrower default, and credit deterioration. Operation risk, losses from failed process, people, system, or external events. Liquidity risk, inability to meet obligation or transact efficiently. Governance is the set of commitments, set of committees, approvals, and reporting lines that oversee risk taking. Risk type leads to risk measure, which leads to risk limit, which leads to capital control. This repeats the change from slide number 16 in regulatory language. The category fixes the metric fixes the limit, and the pair drives capital control. The slide second point is the classification stops an exposure from being missed. If every exposure has exactly one owner category, none falls between the two legs. One clarification here is liquidity risk is treated differently from other three. Market, credit, and operation risk each carry the capital charge. Liquidity risk is governed through ratio requirements and buffers rather than capital charge. So listing all together can suggest a symmetry that does not exist. So that is what we need to keep in mind. Then we have slide number 21, which is common confusion. All losses are market risk. Not every financial loss is market risk, right? A financial loss does not automatically imply market risk. For an asset price, market risk. A borrower failing to repay, credit risk. A system failure causing a loss, operational risk. Inability to sell an asset efficiently, liquidity risk. Loss is not automatically market risk, right? The correct classification depends on the underlying loss mechanism. Loss leads to identify driver and then to classify risk. Insight here is risk should be classified by source and transmission mechanism, not simply by the existence of a financial loss. So the slide basically corrects one error. Treating any financial loss as a market risk, it maps four losses to four categories. It says a fall in the asset price, the market risk, a borrower falling to or failing to repay. Credit risk is system failure, causing a loss is operation risk, inability to sell an asset efficiently, liquidity risk. Loss is not automatically equal to market risk. Loss leads to identify driver, which is to classify risk. The order is fixed. Find what caused the loss first. Assign the category second. The error comes from reversing the two because the loss shows up in the same place, the profit and loss, whatever caused it, right? Slide number 22, common confusion. Hedged means risk-free. A hedge reduces risk. It does not guarantee zero risk. A hedge is designed to offset adverse movement in risk factor. The hedge may reduce the sensitivity of the overall position. However, the hedge itself can introduce, right? Can introduce additional risk. Imperfect correlation can create residual exposure, basis risk, liquidity risk, model risk, and execution risk may remain. For a simple hedge, delta V net is equal to delta V position per delta V hedge. An effective hedge aims for absolute value of delta V net is less than absolute value of delta V position. Key insight is hedging reduces target exposure, does not automatically eliminate every source of risk. So hedge offset and adverse move in a risk factor. The slide lists what it does and does not do. Reducing the sensitivity of the overall position, it can reduce new risk. Imperfect correlation leave residual exposure, basic liquidity model and execution risk may remain. Hedge is the second position taken to offset the first. Basic risk is the risk that the hedge instrument and the hedge position do not move together. Model risk is the risk that the valuation or hedge ratio model is wrong. Execution risk is the risk of an unfavorable price when the trade is placed. Residual exposure is what is left after hedging. Delta V subscript net equals delta V subscript position plus delta V subscript hedge. Delta V position is the value change of the original position. Delta V hedge is the value change of the hedge. The sum is the net change actually experienced. The hedge works when its value change carries the opposite sign to the position. Delta V net absolute value less than delta V position absolute value. The vertical bar denotes absolute value size without sign. The line says an effective hedge makes the net move smaller in size than the unhedged move. It does not say the net move is zero, sign is dropped because a hedge can overshoot as well as undershoot. And both count as residual risk. For clarification here, the criteria is stated for single move. A hedge is done over a distribution move, not one realization, since the hedge can reduce risk on average and still lose on any given day. The practical test is the variance or VAR of the net position against the unhedged position where it is used. This defined hedge effectiveness. It also explained by hedge book still consume market risk capital. The result is measured, not assumed away. Then we go to slide number 23, enterprise risk management, the bigger picture. Enterprise risk management integrates risk views. Enterprise risk management consider risk views across the institution rather than examining each risk independently. Market risk, credit risk, operational risk, liquidity risk, strategic and business risk. The objective is to understand both individual exposures and their interaction. ERM is equal to identify, measure, monitor, and manage. Individual risk leads to integrated risk view, leads to enterprise decision. Key insight, ERM provides a broader framework for understanding how different risks interact across the institution, right? The enterprise risk management look at risk across the whole institution rather than one at a time. The slide lists what it covers: market, credit, operation, liquidity, strategy, and businesses. The stated objective is to understand both individual exposure and their interaction. Interaction is the effect of two risks occurring together, being different from the sum of each alone. ERM equals identify plus measure plus monitor plus manage. This names the four activities in the ERM cycle. It's a definition, not arithmetic. Individual risk leads to an integrated risk view, which leads to an enterprise decision. The chain says the categories are aggregated before decisions are made. Decisions on capital limits and business mix are taken at firm level. So this view must reach firm level first. And then we have next slide, which is about your risk silos versus integrated risk view. Risk silos can hide your important interaction. A risk silo examines one risk category independently from the other. Market risk may be monitored separately. Credit risk may be monitored separately. Liquidity risk may be monitored separately. Interaction between these risks may therefore be overlooked. An integrated view considers the transmission of risk. Market shock leads to credit regulation, leads to liquidity stress. Integrated risk management identifies common driver. It also helps identify concentration that may appear small within individual silos. Risk oversight, risk categories are useful for measurement, but risk management must also consider how these categories kind of interact, right? So risk silos examines one category independently of the other. The slide lists market, credit, and liquidity risk, each monitored separately, and notes that interaction between them are then overlooked. A silo is an organizational or measurement unit that does not share information across the boundary. Market shock leads to credit deterioration, which leads to liquidity stress. This is the same transmission chain as slide number 17. Shortened to 3 links, it crosses two silo boundaries. A team watching only its one category or own category sees one link of the chain and misses where the loss comes from and where it goes next. The slide gives two benefits of the integrated view. It identifies common drivers and identifies concentration that looks small inside individual silos. The common driver is one factor that moves several exposure at once. Concentration hiding is the practical problem. 3 moderate exposure in 3 silos can be there. 3 views of the same underlying factor added up. The position is large. Where it is used, this is the argument performed by stress testing over standalone category metrics and for factor level rather than category level concentration limits. And then we get into next part, which is slide number 25, summary, distinguishing market risk from its neighbor. Distinguish market risk from Other risk, the key is to identify the mechanism through which a loss can occur. Market risk, market variable movement, credit risk, counterparty failure, operation risk, process system failure, liquidity risk, trading funding constraint, business risk, operation performance. One position can contain several risk types. A single loss can propagate through multiple risk channels. Hedging reduces target exposure but does not make a position risk-free. Enterprise risk management therefore requires integrated view, identify driver, classify risk, measure, manage. Insight, understanding the difference between market risk and its neighboring risk is essential for correct measurement, capital allocation, and effective risk management. Okay, so the slide closes with the mechanism test applied to 5 categories. You have the table on the slide, which is given, which we have already discussed. Points are restated. One position can contain several risk types, and loss can propagate through several channels. Hedging reduces target exposure without making the position risk-free. Enterprise risk management requires an integrated view. Identify driver leads to classify risk, which leads to measure, which leads to manage. That is what we need to understand. And overall, if you want to summarize this lesson, right, because we have completed all slides now. So 4 risk categories are separated by loss mechanism, not by instrument or by the size of loss. Market risk is a family of factor risk. Equity rates, FX commodity spread, and each factor needs its own sensitivity in data. Same position carries several risk type at once, and the driver of a given loss decides its label. Real loss cross category boundaries through transmission channels. So silo measurements hide both impedance and concentration. Classification drives measurement, which drives limited limits and capital. So a wrong label at the start, you have everything downstream. Few common mistakes which you need to keep in mind. Classify by instrument rather than by driver. That's a common mistake. Calling every bond loss credit risk or every trading book loss market risk, that's wrong. Treating credit spread risk and default risk the same thing, that is wrong. Credit spread moves are measured as market moves, while the bond still pays. Default is a separate mechanism needing a separate charge. Confusing systematic risk with systematic risk with systemic risk, that's also a problem. The first is the systematic risk is basically the undiversifiable factor in the portfolio theory. Systemic risk is the breakdown of the financial system. Treating your expected loss will feed into LGD into AD as capital. It's expected loss covered by provisional pricing. Capital covers the loss beyond it. Uh, reading a hedge as a moving risk, that also is wrong. The hedge changes the risk profile and adds basis, model, liquidity, and execution risk of its own, right? So keep that in mind. Okay. That's it, guys. That's it for this lesson. Go back and revise it. Very simple lesson, not difficult at all. Go back and at least read it twice. You won't find it too difficult to understand. And once you're done it, I think you'll totally fine. Okay. That's it, guys. That's it for this lesson. I'll see you in the next section. Till that time, thank you.